If you've been following the news, I'm sure you've come across this article by now because it's on every single news channel. Basically, RBC did a study and found that 80,000 of its customers are at risk of hitting their trigger point on their mortgages if the rates keep going up so fast. Now, what is a trigger point and how is that different from a trigger rate? First of all, what's a trigger rate? So there's a lot of confusion and a lot of concern, rightfully so. A lot of people want to know, like, is this going to affect me or not? Or can I just let this come and go and it doesn't affect me at all? So what I'm going to try to do in this video is I'm going to explain to you guys exactly what a trigger rate is, how to calculate it, and if this applies to you. Like, should you be worried or should you not be worried? So I think the best thing to do is just explain like who this applies to. It only applies to people who happen to have a variable rate mortgage and they are on a fixed payment schedule. So let's say if you happen to have an adjustable rate mortgage, it does not apply to you. Secondly, if you happen to have a fixed rate mortgage, you can let this come and go. It does not apply to you either. It only applies to people who happen to have a variable rate mortgage on a fixed payment schedule. So I think the best thing to do is explain it with an example because it's always easier to explain things with an example. So let's say you got an amazing rate about a year ago and your total payment amount on your mortgage is only $1,900 a month. And so far, $1,300 of that has been going towards the interest and $600 towards the principal, for example. But the rates have been going up, this year they have been going up. You guys are well aware of that. So eventually, instead of $1,300 being taken off for interest, it went up to $1,500, then $1,700, then $1,800. And eventually it gets to a point where the rates are so high that the $1,900 per month that you're making is not enough to cover even just the interest. And that is the point where you've hit your trigger rate. So for example, if your payment is $1,900 a month and just the interest payment alone went up to $2,000 a month, that's when you've hit the trigger rate. Now, how do you calculate that? Like, for example, what is your trigger rate? Because it's going to be different for every single person. The best way to calculate the trigger rate is by contacting your bank. They would be the best people to help you because they have all your information. They would tell you exactly when your trigger rate will come and how much you'll be affected by it. But if you don't feel like calling the bank right now and you just want like a rough idea for your own peace of mind, so the basic calculation I've seen online is you take the payment amount that you're making every single month, you multiply it by the number of payments you make per year, you divide it by the balance you owe on the mortgage, and you multiply it by 100. So let's do one example here. Let's say your total payment per month is $2,500 and you make 12 payments per year. So you multiply $2,500 by 12 and divide it by the balance owing, which is $600,000 in this case, and you multiply by 100, and that gives you a trigger rate of 5% in your case. So that would be your trigger rate. Okay, and like I said before, it's going to be different for every single person because this will be different and this will be different and even this will be different in many cases. So there's no set number that's going to be the same for every single person. Now, what happens in this case? Because the interest payment is so much higher than the monthly payment you're making, the interest gets deferred and now you're getting closer to your trigger point. Now, what is a trigger point? It's different from a trigger rate. When the outstanding principal amount, including the deferred interest, exceeds the original principal amount. So that is when you hit the trigger point. Now, what happens when you hit the trigger point? The bank calls you guys and they say, okay, you guys have three options. Either you increase your payments every single month. The second one is you convert to a fixed rate mortgage. Third one is basically you make a lump sum payment. So what is the bottom line of all this? Well, the bottom line is basically that it is going to cost you more money to be living in that house because either you're going to be having to make a lump sum payment or convert to a fixed rate mortgage, which is going to cost you more monthly. So yeah, there's no way around it. It's going to cost you more money living in that house. But I am not a mortgage broker or even a mortgage agent, so please double check, triple check everything with your bank before you make any decisions, and hope you find this a little bit helpful, and I'll talk to you next time. Thanks.